I was chatting with a few friends the other day, and I realized that many people, albeit being very diligent with savings, investing, ETFs, are ignoring the easiest invisible yield out there, the company pension scheme. By not matching our employer's contribution, we're leaving free money on the table, particularly the pre-tax part that grows tax-deferred and invisible to the eyes for additional free cash in a few decades. Europe is fragmented on that, so today we are dissecting a few different countries and the most appropriate strategies for each. Let's get to it. Hello fellow wealth seekers! We start with the UK, the most diligent at that. They are legally requiring a minimum of 8%, of which 3% is paid by the employer. So an optimal match is 5 and 3. This already deducts from your gross income, coming up as a salary sacrifice that is exempted from income taxes and national insurance, making you an effective double tax shield. Secondly, Germany. Here we're talking about the betriebliche Altersversorgung, which is basically your state pension. What is the game changer is Entgeltumwandlung, which basically means converting part of your gross salary into an additional integrative pension scheme. On this one, you save on Social Security, and the employer that matches that saves on that as well. Generally, they are transferring 20 to 25% of those savings by default and never less than 15% by law to your betriebliche Altersversorgung, so your public pension on top. This basically also acts as a double tax shield. What I recommend you to negotiate is at least 25 to 30% of those savings into your betriebliche Altersversorgung, so that you offset any potential fees or insurance costs that are famously high in Germany. 3. The Netherlands. They are robust, with generous, widely available employer matches. But the true game changer is the Jahrräumte. Here, you can basically ask the tax agency to calculate exactly how much of your optimized employer contribution is not maxed out yet and cover the gap yourself with taxed income to make it so that this is claimed back from the highest marginal bucket rate that you have already been charged in taxes, effectively regaining the tax advantage at the source. 4th, Italy. A widespread error, simply mystified over the years, is that TFR, severance pay, that you mature over the years of being employed within a company, is the best way to save your retirement money. Keeping it in the company, safe, but actually this compounds very slowly and often barely tied to inflation rates. What should be done is diverting this into a fondo pensione negoziale, which is basically a closed index fund pension scheme that not only matures higher interests, at least the ones of bonds, but also forces 100% matching from the employer. Also, upon tax withdrawal at the end, this is capped between 9 and 15%, notably undercutting the basic taxes on income that the severance pay, TFR, is subject to. An easy workaround. Lastly, the French architecture, the winners. Here, albeit tied to specific annual limits, the employer match, abondement, can reach up to 300% your contributions. You heard me right, 4 times over. Anybody must strictly maximize this out before considering any other investment. Entirely pre-tax capital that even becomes completely tax-free regarding capital gains after merely 5 years. An absolute deal. Let's sum it up. Basic advices on the street tells you to save. Mainstream finance tells you to buy ETFs. The lab tells you to exhaust all your free capital and tax arbitrage before considering any other investment. This is free money that would end up in the pockets of the state or of your employer if you simply leave it on the table. Make sure you reevaluate your contract, talk to your employers regarding possible matches, and start with your pre-tax alpha considerations today. Until the next session, the Wealth Lab out.